There's a check waiting for tens of thousands of Canadians. It's worth up to $13,000 a year. It's completely tax-free, and most of them will never cash it. Every single year, eligible Canadians leave hundreds of millions of dollars in tax-free retirement money on the table. Not lottery winnings, not a scam. Money that is already theirs, just never claimed. Picture a retiree at the grocery checkout, counting coins, putting things back, stretching every dollar. And the whole time, $1,100 a month is sitting there, waiting, unclaimed. Here's the thing. Most people think, I saved a little, I own my home, I'd never qualify for this. Honestly, that belief is exactly the trap that costs them thousands. Because there's one account most of you already have that the government doesn't count against you. Stick around to Chapter 5, where I show you how someone with a paid-off house still collects this, legally. This is the Guaranteed Income Supplement, the most overlooked money in Canadian retirement. By the end, you'll know how to claim every dollar, for you or for your parents. So let's get into it. Okay, so here's exactly what you're going to walk away with today. 5 things. Get these right, and this could be worth 6 figures over your retirement. I'm not exaggerating. Number 1. What GIS actually pays in 2026, the real numbers. Number 2. The income limits that decide if you qualify and why so many people guess wrong about their own situation. Number 3. The one account the government does not count, the quiet loophole I keep teasing. Number 4, the legal strategy to set up your income so you actually qualify. And 5, how to actually claim it, including how to get back pay for your mom or dad who might be owed this money right now. That part alone could be worth thousands. If we haven't met, I'm Jay. This channel is where we break down one Canadian money move a week, the stuff that actually keeps more cash in your pocket, not the recycled American advice. Quick disclaimer, because we have to, this is not financial advice. Always do your own research. Cool? Cool. Now let's start with the number that makes people sit up. What this thing actually pays. So what is this? GIS stands for the Guaranteed Income Supplement. It's a monthly payment from the federal government for retirees with lower income. And here's the best part, it is completely tax-free. Let's talk real numbers. If you're single, widowed, or divorced, the maximum is about $1,100 a month in 2026. That's over $13,000 a year, tax-free. Now, sit with that for a second. $13,000 and the CRA doesn't touch a cent of it. No tax slip, no clawback on the GIS itself. For a lot of retirees, that's groceries and the heating bill covered. Couples, your numbers work differently. If you both get OAS, each of you gets a lower amount, around $670 a month. The single, widowed, or divorced rate is the high one, up to about $1,100 a month. Here's something most people miss. GIS is tied to OAS, Old Age Security. You have to be getting your OAS pension first, so GIS sits on top of OAS, like a bonus layer for lower-income retirees. And unlike a lot of things in your life, this one actually keeps up with inflation. The amounts get reviewed 4 times a year and bumped up with the cost of living, so it rises as your grocery bill rises. Let's zoom out. Say you collect this for 20 years of retirement. $13,000 a year, tax-free, adjusted for inflation. That is well over $250,000. This is not pocket change. This is real money. Now, you might be thinking, that sounds amazing, but I'll never qualify because I have savings. Hold that thought, because in about a minute, I'm going to show you why that's often dead wrong. Because whether you actually get this comes down to one thing, your income. Not your savings, not your house, your income. And the rules there are where it gets interesting. Qualifying comes down to 3 simple gates. 1, you're 65 or older. 2, you're getting your OAS pension. 3, your income is under a certain line. That's it. Miss the income line and you're out. Here are the lines for 2026. If you're single, your income needs to be under about $22,500 a year. And remember, that does not include your OAS pension. If you're a couple and you both get OAS, Your combined income needs to be under about 30,000. If one of you doesn't get OAS, that line jumps to nearly 54,000 combined. Now, the myth I promised to bust. So many Canadians look at their paid-off house and their savings account and think, I've got too much, forget it. But here's the thing. GIS doesn't care about your net worth. You could own your home outright, have a healthy nest egg, and still qualify. Why? Because the test is your taxable income each year, not the pile of money you've already built. That distinction changes everything. So what counts as income? Your CPP, any work pension, money you pull from an RRSP or RRIF, plus interest and investment income. All of that lands on the income line. But, and this is the whole game, not every kind of money counts. There's one major source the government completely ignores. That's the loophole, and we are one chapter away from it. Quick one for anyone working a little in retirement, maybe a few shifts or some consulting. The first $5,000 you earn is ignored, and half of the next $10,000 too. So a part-time job won't wreck it. So your savings are safe from the test, some work income is forgiven, and there's a mystery account that doesn't count at all. Ready for the part that makes this whole thing click? Let's open that vault. All right, this is the chapter I promised you in the first 60 seconds. The account the government does not count when they check your GIS income, your TFSA. Yeah, the tax-free savings account. Here's why that's massive. When you pull money out of a TFSA, it does not show up as income. Not for taxes and not for the GIS test. You could withdraw $40,000 and the income line wouldn't move. Compare that to an RRSP. Every dollar you take out of an RRSP counts as income, which can shrink your GIS by 50 cents on the dollar. Same money in your pocket, totally different result. So picture two retirees, same lifestyle, same spending. One funds their retirement from a TFSA, the other pulls from an RRSP. The TFSA retiree can collect thousands more in GIS every single year. Same money, smarter order. And it's not just the TFSA. Your OAS pension itself isn't counted in the income test either. So the system is layered. The trick is knowing which of your money buckets the government actually looks at. Let me reset for a second in case you just landed here. We're talking about up to $13,000 tax-free dollars a year. And the single biggest lever to unlock it is which accounts you spend from first. Think of it like the cottage on a long weekend. Everyone's crawling up Highway 400 at the same time. The smart move isn't more gas, it's leaving at the right time. Same with your accounts. Order and timing win. Now, I want to be straight with you. This isn't about hiding money or cheating. It's completely legal. It's how the rules are written. But it does take planning before and during retirement, not the night before you apply. So the question becomes, how do you actually set your income up to land under that line on purpose, without living like you're broke? That's the strategy. And that's exactly where we're going next. Okay, the playbook. There are 4 moves here. None of them are complicated, but together they can swing your GIS by thousands a year. Let's go through them one at a time. Move 1. Fill your TFSA for life. During your working years, every dollar you can get into that TFSA becomes a dollar you can spend in retirement without it ever touching the income test. This is your foundation. Move 2. The RRSP meltdown. Sounds scary, it's not. The idea is to draw your RRSP down earlier in lower income years before GIS, so you're not forced to pull big taxable chunks out later when it would cost you GIS. Here's the move. In your early 60s, you slowly pull from the RRSP and either spend it or shift it into your TFSA. By the time GIS matters, that RRSP is smaller, so your taxable income stays low. Move 3. Mind your CPP timing. CPP does count as income, so a bigger CPP check can quietly reduce your GIS. For some people, taking CPP earlier and smaller, paired with more TFSA income, actually nets out better. Now, this one is really personal. Delaying CPP gives you a bigger guaranteed check for life, which is great, but if it wipes out your GIS, the math can flip. This is exactly where running your own numbers pays off. Move 4. Keep your investments inside the TFSA, not in a regular account. Interest, dividends, and gains in a normal account all count as income. Inside the TFSA, they're invisible to the GIS test. If you're a couple, there's a bonus move, splitting income so neither of you crosses the line. Pension splitting and spousal planning can keep you both under the threshold instead of one of you blowing past it. Put these together, and here's what happens. You're living comfortably, spending from your TFSA, your taxable income sits low on paper, and the government tops you up with thousands in tax-free GIS. Legally, by design. But, and this is a big but, there are landmines. A few simple slip-ups can erase your GIS for an entire year, even if you did everything else right. Let's make sure you avoid them. These are the mistakes I see over and over. Any one of them can cost you thousands. So even if you remember nothing else, remember these. Mistake number 1 is the most common and the most painful. Mistake 1, not filing your taxes on time. This is the big one. GIS is renewed every year from your tax return. Miss the filing and your payments can just stop, even if you still qualify. And here's the cruel part. Some of the people missing out aren't wealthy. They're the most vulnerable. Folks who didn't know they had to file because they earned almost nothing. File your taxes, even with zero income. Mistake 2, a surprise RRSP withdrawal. Say you pull $20,000 from an RRSP for a new roof. That spikes your income, and it can wipe out your GIS the following year. Timing that withdrawal matters enormously. Mistake 3, a big one-time capital gain. Sell the family cottage or a chunk of stock in the wrong year, and that gain counts as income. Suddenly, you're over the line and your GIS vanishes for 12 months. Mistake 4, not reporting a change in your marital status. If your spouse passes away or you separate, your income thresholds change. Tell Service Canada because the wrong status can mean the wrong payment or none at all. Mistake 5, assuming you're automatically signed up. Some people are auto-enrolled, but not everyone. If you never got a letter confirming it, do not assume. You might be sitting there waiting for money you never actually applied for. Mistake 6, the retirement year trap. GIS looks at last year's income, so your final big working year can delay it. But there's a fix. You can ask Service Canada to use your estimated lower retirement income instead. Be honest, how many of these were you about to walk into? Someone watching right now was one cottage sale away from losing a year of GIS. Drop a comment if this just saved you. I read them. Okay, you know the money, the loophole, the strategy, and the traps. Last piece, actually getting it into your bank account and getting back pay for a parent who's been missing out. Let's bring it home. Step 1. Find out if you're already enrolled. Log into your My Service Canada account or look for a letter from Service Canada around age 64. If you see it, great. If not, you apply, and it's not hard. Step 2. If you need to apply, you can do it online or with a paper form. You'll confirm your income and marital status. Then you keep it alive by, you guessed it, filing your taxes every single year. Step 3. Ask about back pay. If you were eligible and didn't apply, Service Canada can pay you retroactively, generally up to 11 months. That can be a single deposit worth thousands of dollars. Always ask. Now, this next one might be the most important thing you do this week. Call your parents. Ask if they're getting GIS. If they're on a fixed income and they're not, you might just find them thousands of dollars. And here's a bonus most people never hear. Once you're on GIS, doors open. Many provinces use it to unlock extra help. Drug coverage, property tax and rent rebates, even heating and home care support. One approval, many benefits. One more. If you're between 60 and 64 and your spouse gets GIS, there's a separate benefit called the allowance. And if you'd lost a spouse, the allowance for the survivor. Don't leave those on the table either. So let's bring it all together. GIS is up to $13,000 tax-free dollars a year. Your TFSA is the key. Plan your withdrawals, file every year, dodge the traps, and claim what's yours. If this helped, do 2 things. Hit subscribe because every week I break down one Canadian money move exactly like this, and share this with one person who needs it. That's how this money gets claimed. And tell me in the comments, what province are you in? Drop it below, and I'll point you to the extra benefits that stack on GIS where you live. I'll see you in the next one.